Hey everyone, welcome back to Corporate Jargon, the place where we crack open the financial statements of public companies and explain what it all means in plain English, just in case you're new here and wondering what we're diving into today. Imagine a company that wants to make buying stuff easier and also help charities at the same time. Sounds cool, right? Well, let's see if their numbers back that up. We're going to dissect their latest filing to understand their financial health, their risks, and what their future might look like. So grab your magnifying glass and let's get started. Before we jump in, if you're someone who wants to cut through the corporate jargon and get to the real financial story, then smash that subscribe button. We also have a fantastic community over on our Discord linked in the description where we discuss these filings and much more, so consider joining us there. This document is essentially Givbux Inc.'s application to let people buy its stock, like a public introduction to the stock market. It talks about how many shares they plan to sell and how they've gotten to this point. This is the actual form they file when they want to go public. It's a big deal because it means they're opening themselves up to public investment, and that comes with a lot of rules and disclosures. Now they're calling themselves a smaller reporting company, which basically means they're not a giant corporation yet. This usually comes with some lighter reporting rules, which can make things a bit simpler for them, but maybe a little less detailed for us investors trying to figure things out. They even put in writing that buying their stock is a gamble. This is a pretty big red flag right up front. They're not beating around the bush about it, which is almost a relief. They're being upfront about the uncertainty. So they're already trading, but on the pink market, that's like the wild west of stock exchanges. It's not a major exchange like the NYSE or NASDAQ, meaning less regulation and potentially more volatility, which matches their own warning about risk. Let's quickly look at what's inside this report. It covers everything from the business itself to the risks they face, and even how they plan to sell their shares. It's a pretty standard structure for a company trying to go public. This part tells us what to expect from the rest of the document. It's important to remember that this is a preliminary prospectus, meaning the information could still change before everything is official. And remember, they're not selling any shares in this offering. It's a selling shareholder Kipspace Select LP that's doing the selling hard for. This is a crucial section. They use words like anticipates, believes, expects, and plans to talk about the future. But they're also warning us that these aren't guarantees. Things could turn out very differently. And they list several reasons for this, like needing more money to operate and having a constantly changing business model. This is a big heads up that their future is uncertain. This is a key risk for any tech company. If they can't keep up with new technology, they'll fall behind, which is obviously bad for business. Here they give us the elevator pitch for the company and the offering. It's always good to get a quick overview before diving into the details, but remember, this is shortened information, so we still need to read the longer sections. Givbux has a history of changing its business multiple times, from soap to tires and now to a fintech super app. This shows a bit of a struggle to find its footing and a lot of pivots. It's interesting that they had to become a reporting company again in 2024 after ceasing to be one in 2009. Their main product is the Givbux super app. It's designed to be a one-stop shop for users storing money, sending rewards, chatting, and even donating to charity brands benefit by having a tool to reach customers through their phones. It tracks user activity like purchases, rewards, and donations. This highlights that their entire business logic is built around this one app. If this app doesn't succeed, the company likely won't either. They're in the fintech wallet sector with a super app that aims to blend purchasing with charitable giving. They use smartphone technology to connect consumers and merchants directly. It's a network marketing strategy aiming for exponential growth by engaging leaders and their downlines. There are subscription fees and transaction fees. Their revenue streams include facility rental subscriptions, transaction fees from purchases, and advertising by merchants. As of late 2024, they had just over 11,000 users and 258 merchants. That's not a lot of users for a company year end, especially when they are looking to grow exponentially. This is how they've been raising money. They've sold convertible notes and warrants, which are essentially promises to pay back money later or give stock instead. They've raised money in tranches, meaning in stages, and this financing is key to their survival and growth. The note has a maturity date of December 2025 and accrues interest. The key thing is it's convertible into company stock. This means if the stock price goes up, the note holder can convert their debt into equity. Warrants are like options to buy stock at a certain price. They can be exercised for shares of common stock, and their exercise price depends on the stock price, or if there's an event of default, This just means the investors who bought these notes and warrants have the right to have the company register their shares so they can be sold publicly. It's a common feature to make these investments more attractive. Now we get to the most important part where they tell us everything that could go wrong. And there's a lot here where we see the real picture. They're very upfront about the risks. This is a classic risk for fast-growing companies or companies trying to grow fast. If they can't handle the growth, it could break the business. They reported revenue and subscription revenue here in 2024, but it's a small number given their overall expenses. This will likely strain our operational capacity is a key phrase. It shows they are already feeling the pinch of their current size. This is a critical financial point. They've lost money consistently and might not achieve profitability. This is a major concern for investors looking for a solid return. This is a significant warning. They are a penny stock. Their stock is traded on the OTC pink sheets, which means very limited liquidity, which means it could be hard to sell your shares. This means there could be a lot of selling pressure on the stock, potentially driving the price down even further. They mention their stock is quoted on the OTC pink market, and the last bid price as of July 2025 was 1.65. I'm guessing the asterisk here means the actual number is redacted, but it is very low. They don't pay dividends and don't plan to in the foreseeable future. This means investors won't get any regular income from their investment, only from potential stock price appreciation. The company isn't getting any money from this stock sale. It all goes to the selling stakeholder. The only money the company might get is if the warrants are exercised, which is up to $11 million, but that's not guaranteed. They reiterate their history of pivoting from soaps to tires and then to fintech. This kind of inconsistency can be a sign of a company struggling to find a profitable business model. They describe the Givbux super app features again, focusing on the social and charitable aspects. They claim constant improvements are being made and a new version is planned for late 2025. This is a breakdown of who uses their platform, and it's important because their business model relies on this ecosystem. They list facility rentals, subscriptions, transaction fees, and advertising as revenue streams. For 2024, they reported over $544,000 in revenue. Here they list the actual revenue streams: facility rentals, subscription revenue, and transactional fees from retailers. In 2024, they had $544,000 in revenue. They acknowledge that giving to charities through payment portals is becoming common. They mention competitors like PayPal and FlipGive with different approaches to fundraising. As a fintech company, they have to comply with many regulations like consumer protection, anti-money laundering, and data privacy laws. They have limits of 1,000 per day for transfers and monitor user activity to prevent fraud. This is where management explains the financial numbers in their own words. They usually try to put a positive spin on things, but we need to look for the underlying facts. This is a very serious section. They've had significant net losses and accumulated deficits, and their current liabilities exceed current assets. They explicitly state there's substantial doubt about their ability to continue as a going concern. This means they might not be able to stay in business without more funding. For the years ended December 31, 2024 and 2023, they had limited operations and generated revenues of $540.24 versus about $96,000 in 2023. That's a big jump, but their expenses way outpaced it, leading to a net loss of over $3.3 million in 2023. The massive increase in expenses, including a huge stock-based compensation charge for marketing, is a major concern. This is a fundamental problem for any business. They are burning cash to operate, not generating it. This puts them in a precarious position without constant new funding. This is a stark reminder of their financial struggles. The company lost over $3.3 million in 2024 alone. The deficit here means the company owes more than its assets are worth, a consistent theme with this filing. For the first 3 months of 2025, they lost another $500,000. This continuing trend of losses is a major red flag. This table shows how cash moves in and out of the company. The most critical takeaway is that they consistently use more cash than they bring in from their operations. This line item clearly shows they are spending more on operations than they are earning from the core business, which means they rely on external financing to keep running. This is where they expand on the going concern qualification. They admit substantial doubt about their ability to continue as a going concern without more funding, and that's never a good sign. This note details how they account for their business transactions like revenue recognition and stock-based compensation. We see they adopted new revenue recognition standards, but it didn't impact them much because they have so little revenue. The numbers here are tiny and negative, which is expected given their losses. This is important. They owe a substantial amount of money to related parties, specifically over $900,000 as of March 2025. This raises questions about potential conflicts of interest and if these loans could be called in at any time. Here we see details about various loans payable. Some are due on demand and many are in default. This is risky. For example, many loans are due on demand and the company is in default on many of them. This table is extensive, showing numerous convertible notes. Many of these notes are also in default or have past maturity dates, raising serious concerns about their debt obligations. Square Convertible Note Square, the company has issued a lot of convertible notes with varying interest rates and conversion prices. Many are in default or past due, which is a very serious financial risk. They are recognizing derivative liabilities because their convertible notes have features that are treated as derivatives. This adds complexity and can lead to gains or losses that affect their financial statements, which are mostly level 3 inputs, highly subjective. This shows they have common stock and preferred stock series. B and C preferred stock have complex terms and voting rights. They have a huge accumulated deficit, meaning they've lost a ton of money over time. This section is standard. It outlines their commitment to file updates and amendments if needed. This is part of the standard process for going public. Finally, the management signs off on this document, confirming their responsibility for the information provided. So what's my take on Givbux Inc. based on this filing? Well, the company is definitely in startup mode, trying to carve out a niche in the fintech market. With a social giving twist, they've got a product in the super app, which is great, but the financials are really concerning. They're burning cash at a high rate, have a history of losses, and many loans are in default or past due. The fact that they are already talking about a going concern doubt and the risk that they may not be able to continue operations without more funding is a major red flag. The heavy reliance on related party loans and the history of pivots also raise questions about stability and strategic direction, while their intention to combine purchasing with charity is interesting. The current financial situation and the highly speculative nature of their stock, as they themselves admit, would make me very cautious. We've seen a company trying to find its way with a lot of past business changes and a current app that's still in its early stages financially. It's a tough picture with significant risks from debt and ongoing losses. The market is competitive and their ability to scale and achieve profitability remains a huge question mark. Alright, that's our breakdown of Givbux latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribing for more deep dives is always a great idea. Don't forget to check out our Discord in the description below. Thanks for watching. See you next time.